You've rightly flagged those assets as being important to us, and those are the three that we regularly refer to as our growth assets. And by that, we mean that they have huge potential to deliver meaningful capital uplift above what we paid for them. And we've already started seeing that come through in this NAV, as you say.
Hello, you're watching Proactive. Joining me is Foresight Environmental Infrastructure Investment Manager, Ed Martney. Ed, very good to speak with you. You've reiterated that FGen remains on track to hit its full-year dividend target, equating to a 12% yield. What gives you the confidence to maintain this in what's been a challenging market?
Yeah, thanks, Stephen, and good to speak. Well, I think there are a few things that are contributing towards that, and I guess the first thing to pull out is that we're really pleased with another period of solid underlying portfolio performance. We have a strong, diversified asset base that's now delivered consecutive periods of record cash flows for each of the past 10 years, and we're really encouraged by a strong dividend cover of 1.22 times for the first 6 months of this year. And then on top of that decade of track record, we have a relatively low gearing ratio and a high proportion of contracted revenues. And we think that combination also gives us a really good visibility over cash flows. And so we're optimistic that we can extend that dividend cover for the rest of this year and maybe even improve on it slightly with a few tailwinds.
You've highlighted the commitment to closing the share price discount to NAV. What specific steps are you taking and what should investors expect over the coming months?
Yeah, it's a good question. We get asked it a lot. I guess the first thing to say here is that both the FGen board and the investment manager remain deeply disappointed and frustrated with the discounts to which the infrastructure and renewable energy investment companies are facing at the moment. So earlier this year, the board at FGen conducted an independent review of the strategy that we're following, and that considered all available options with regards to the strategic direction of the company and how best to deliver maximum value for its shareholders. And what that exercise concluded was that not only does FGen remain absolutely relevant in the current investment landscape for environmental infrastructure, but it also has some uniquely exciting assets that show real promise for offering meaningful growth potential over the medium term. So the current focus now remains on ramping up those assets and delivering on the strategy of managing a portfolio of steady operational assets capable of covering our progressive dividend, but also paired with delivering attractive gains on our portfolio of growth assets. And that stands at nearly 20% of the portfolio now.
As you mentioned, Ed, operationally, the portfolio delivered strong cash flows and that dividend cover of just over 1.2 times. Which assets or subsectors have been the biggest contributors to this resilience?
Well, one of the most pleasing things about this set of results is that it was a really good illustration of why we set out to construct a diversified portfolio rather than focusing solely on a single technology. So again, looking at this set of results specifically, whilst wind resource was disappointing this period, meaning that energy generation from that part of the portfolio was about 6.5% below budget, actually solar irradiation was really good. And that part of the portfolio was just over 6% above budget. And then you layer on our crop-based anaerobic digestion assets, which continued their tradition of outperforming budgets. So we can look at that in the round and say, despite some ups and some downs, generation for the first half of the year is expected to come in just marginally ahead of budget. And like I said, that's a really good illustration for us of why a diversified portfolio contributes to a more stable overall group performance.
Several growth assets, so CNG Fuels, Rukyan Aquaculture, and the Glasshouse already contributing to NAV uplift. How meaningful could these become in driving total return over the next few years, Ed?
You've rightly flagged those assets as being important to us, and those are the three that we regularly refer to as our growth assets. And by that, we mean that they have huge potential to deliver meaningful capital uplift above what we paid for them. And we've already started seeing that come through in this NAV, as you say. So if I just take each of those three in turn for a moment, just to give everyone an idea of what they are. So firstly, if we look at CNG Fuels, that's our investment into a really exciting network of bio-CNG refueling stations for heavy goods vehicles across the UK. It continues to sign up major UK fleets, so it's got pretty much all of the major fleet operators that you could think of in the UK, and it has ambitions of becoming Europe's leading integrated supplier of alternative fuels for commercial fleets. So there's a lot of exciting things going on there. Then we've got our co-located 2.4 hectare glasshouse facility for growing high value crops, and our operating partner there is growing heavily regulated cannabis plants for pharmaceutical use under a very strict and special license from the Home Office. And that business has made really great strides in recent months and has huge potential ahead of it as well. And then lastly, Rjukan aquaculture facility in Norway. So that's growing trout by using specially designed technology with significant sustainability benefits compared to conventional near coastal pens. Now, construction of that facility is now coming to an end, and we've recently completed our first trial harvests as we build towards ramping up the cycle of more regular harvests and trout sales. So putting all this together, following years of hard work, this is actually the first period where all of those 3 growth assets are now operational, and we've taken our first steps to realizing some of that value. And we think the foundations are there now for us to work towards realizing the meaningful capital appreciation that these assets have the potential to deliver via targeted disposals in the next couple of years, as we look to make the company's capital work hard for its investors.
Ed, where do you see the biggest risks and opportunities in the current green infrastructure environment?
Yeah, again, another question that we get asked pretty regularly. And I guess the first thing to say is we remain confident in our portfolio's ability to deliver long-term value for investors. While the growth assets that I just talked about, they offer meaningful upside potential that could unlock additional opportunities for further growth. We're also optimistic about the structural drivers that underpin the green economy, both inside of renewable energy, but also more broadly in terms of things like how we manage our resources and the significant investment opportunities that those areas present. Meaning our broad investment mandate positions us well to capitalise on that sort of opportunity. That being said, we remain cognizant of the regulatory environment that we sit in. Things like the ongoing RO consultation doesn't necessarily help the broader investment landscape. But given the diversified nature of our assets and our portfolio, we anticipate a relatively modest impact on FGEN. And things like that are exactly why we've set up FGEN the way that we have. And we really hope that this positive set of results reinforces the strength of our unique investment mandate, keeping FGEN well placed to navigate whatever operational risks that arise.
Ed, I hope you'll continue to keep us updated on your progress. Thank you very much for speaking with us today.
Well, thanks for having me, Stephen.
Ed Mantney, as investment manager at Foresight Environmental Infrastructure.